Bank of Canada has left its rates unchanged in recent meeting as inflation came down to 5.9% in January's data in the backdrop of multiple rate hikes last year. But on the other hand, Canadian dollar fell sharply to its weakest level in recent months after this announcement. Hi, my name is Sunny and I make content that affect a common man financially. If you are new to this channel, please subscribe to it alongside smashing that like button as that will help me with the YouTube algorithm, which of course will be highly appreciated. Bank of Canada today kept their benchmark rate unchanged while emphasizing the continued policy of quantitative easing. Let's listen briefly to this report.
The Bank of Canada will be holding interest rates across the country. That means the key interest rate will remain unchanged at 4.5%. This is the first time in more than a year Canada's interest rate has not increased. This is encouraging, although widely expected news for borrowers, as the bank signaled back in January a conditional pause on further increases, with growing evidence record high inflation is beginning to ease.
Bank of Canada further mentioned about slower global growth, whereas inflation, which is still too high but has been on a downward trend mainly due to lower energy prices. Inflation eased to 5.9% in January, reflecting lower price increases for energy, durable goods, and some services. During their decision, the bank indicated that it expected to hold policy rate unchanged at current levels as long as evolving economic scenarios stay in line with their monetary policy's outlook. At the end, they reiterated a continued quantitative tightening. I understand these are challenging times for Canadian economy and households who are feeling the heat from inflation and rising interest rates. Let's see what Canadian Finance Minister told Global News recently.
Economists have warned that a recession is coming. You're projecting two scenarios, a soft landing and a hard landing. I know there is a lot of uncertainty, but what will it take to hit that soft landing and avoid a recession?
Now, you're right. We also have a downside scenario because, as you have pointed out, some people have become a little more pessimistic, and we thought it was important, transparent with Canadians about that, and also, frankly, to show them that we stress tested the federal finances, and we can show you that even if things get a little worse, Canada is going to be.
I know you said you can't compensate every Canadian struggling with the rising cost of living, but people do want some solutions. Is what is in this mini budget enough?
There are a lot of solutions in this fall economic statement that can make a lot of difference for a lot of people. And I want to highlight one thing that is maybe the most important for me that I announced today. And that is that tomorrow, our GST credit is going to give nearly $500 to Canadian families who need it the most. That is going to start arriving tomorrow in people's bank accounts, in their mailbox.
You talked today about keeping Canada's fiscal powder dry. What does that actually mean, and what are you reserving it for?
We get that now is a really worrying time for a lot of Canadians, and it is understandable that people would be worried. We had 2.5 years of COVID. Who could have imagined that? And things seem to change every month. And now we have inflation, something we haven't experienced in a generation. And people are talking about how maybe the global economy is going to get even tougher. So I think a lot of Canadians are really anxious. And when I say we're keeping our fiscal firepower dry, what I mean is Canada is strong. The federal government has the resources to support Canadians come what may.
Chief Economist at CIBC said, and I quote, "The Bank of Canada has to keep its wait and see approach because it does not have enough data yet to say whether it needs to raise rates again or can firmly say a peak for current tightening cycle has come." He further said, should this momentum continue, it could cause inflation to spike again, forcing Bank of Canada back into hiking mode in coming months, close quote. Our pause on rate hikes came at a time when the Fed hinted that rate might need to go up in the US. Some experts are of the opinion this widening gap between US and Canadian rates could translate into a weaker loonie. The moment Bank of Canada announced pause in its benchmark rate hikes, value of loonie hit a 4-month low in comparison with the US dollar. Some economists believe Canadian consumers should not expect to take a major hit on their wallets because a depreciating loonie is a pretty small price to pay relative to record high inflation that we all are facing right now. Surely, this will take a bite out of consumption while adding a minor inflation, as weakened loonie could make goods and services denominated in US dollar more expensive. I think that is why Bank of Canada kept rates unchanged this time, where they might have weighed all the probabilities, including having lesser effect on economy than rate hikes. Mortgage rates at the moment are rising at their fastest pace in at least 30 years. As mortgage rates go up, it becomes more expensive to finance a house, which leaves many home buyers with lower budgets out. I believe the current demand in housing market could be because of multiple reasons like increased rate of immigration, demand from millennials looking for their first home, coupled with relatively low supply of new housing. But as long as mortgage stress test remains in place, rates stay within historic average range, not fall back to ultra low rates again, speculating buying will be minimum and only genuine end users who can afford mortgage will be buying in most cases. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.